We'll take a look at it maybe one day in closer depth, but certainly that not the focus when we're looking at that consumer basket at this stage and where consumers are spending, because the kind of increases we're seeing in inflation here in South Africa coming through primarily at this stage of the game from food and fuel. So let's go through that.
That is true, and it is to a certain extent encouraging from a point of view of the durability of this inflation spike and how the Reserve Bank is supposed to respond to it. Because if you look at food prices, you mentioned, we have gone into double digit the past month already, and in November we moved slightly further higher. Petrol inflation peaked but remained very high. But if you exclude this petrol, food, electricity items, which explain about half of the inflation rate, you end up with an inflation rate which is just below 4%. So there isn't broad-based inflation pressures, at least not yet.
Taking a look at it though, I mean, we've breached that 3 to 6% target band. We've got the central bank saying that we're looking at hitting a peak of 6.3% in the first quarter of next year. Do we run the risk of moving beyond that?
Well, there's always a risk, but right now I'm not too worried, because I do feel that when it comes to food inflation, we're probably close to the peak. Petrol inflation also probably edges down a little bit in the first half of next year, because we've got to remember at the beginning of this year, prices of food and petrol were already rising fast. So these big rises drop out of the year-on-year comparison. As a result, your base effect turns more favorable in the first half of next year. So we could even undershoot a little bit this forecast of the Reserve Bank. What I think, though, is with the rand having weakened, the disinflationary effect of past rand strength, or the strengthening of the rand in late 2009 and 2010, will be replaced next year, but an inflationary impact of this year's rand weakening. So as one segment of the basket starts behaving better, the other probably becomes less favorable. So we'll be flirting with the top end of the target range for most of next year. But I don't think, unless the rand weakens more significantly, that we will see a major overshoot, because the economy is not just that strong. There isn't a huge amount of pricing power for businesses at present. Let's
take a look at that rand weakness that has filtered through. We've lost about 14% of value year to date. What's your outlook on the local unit? Because today we've seen that euro flirting with 11-month lows and the dollar index up at 11-month highs.
Well, clearly when you are in an environment where risk aversion is high, there is some flight to safety or flight to familiarity, as I heard say, because the dollar is not necessarily a safe asset. After all, the dollar has depreciated on trend over the long run. But the history shows that when there is big bouts of risk aversion, money goes back to the familiarity of the US dollar. So clearly, I mean, in the short term, the rand is dependent on what happens to global market sentiment, in particular how global investors assess the EU risk post the weekend summit, whether they see it as on balance a success or on balance not. Even if you assume, however, that the rand will not be hit by a major Eurozone crisis, I mean, we're still talking about a situation where the Eurozone will be in recession, where the rest of the world will be in relatively slow growth, and potentially commodity prices are not as favorable as they have been over the past year or two. So even if you don't have a full blowout crisis, you probably have a negative macro and commodity environment for South Africa, at least more negative than it was over the last 2 years. So in my view, even if you don't see much more rand depreciation for now, it would be very difficult to go back firmer than 8 rand to the dollar. And maybe in a year from now or so, where we are or moderately weaker.
How are you assessing the EU risk at this stage, given all that's played out post-summit that ended on Friday?
Well, I mean, clearly there is a willingness among EU policymakers to avoid the full-blown crisis. Even if there's no major convergence between many countries, and maybe there's less convergence than there was 10, 20 years ago, they don't want to make the jump in the unknown of the breakup of the zone, mass cities orderly defaults, because they probably realize that it means a deeper recession from pretty much everybody. So no politicians want, first of all, to be responsible for it. Second, to be blamed by history for the one or the ones who broke up the Eurozone. But at the same time, there's still obstacles about going very far. We've seen that talking about a fiscal union as a pendant to as a pending factor to the monetary union is you can easily talk about it, but achieving it, getting the consensus for it, getting the texts or the treaties which make it binding is more tricky. So it all depends about, to a certain extent, what kind of signals policymakers give to markets and how confident markets are or not.
Yeah, it's of course important to unpack that entire scenario, because under normal circumstances, the kind of situation we find ourselves in on an inflation perspective would have also already triggered the South African Reserve Bank to move on a monetary policy and moving to tighten. Of course, we're not operating in normal circumstances right now. What's your outlook in that regard, and where the central bank is possibly headed with rates as we move into 2012?
Well, I think if you look at the level of interest rates now, both in nominal terms and also in real terms, if you subtract inflation from the repo rate, you're at zero, or you're even slightly negative. This is unusually low. I know some people will argue that interest rates were too high on average over the last 10 years, which I'm not convinced about. But anyway, I think we can all agree that monetary policy is fairly loose at present. And that ultimately, if there is a normalization of the economic situation, it will make sense to raise the interest rate from current levels, unless inflation, of course, falls back significantly. But that's not what we really expect, especially if the rand weakens. Now, as long as the economy is weak and there's a severe level of downside risk to the economy, the Reserve Bank can argue, pointing in particular to slack in the economy, to an existence of an output gap, that by the end of the forecasting period, inflation will be back within target. That's what they're saying, So in that framework, there is justification not to hike rates now, because you can say, well, even with the current level of rates, in 5, 6, 7 quarters, we're back within target. Now, obviously, if there are factors, whether there is rand depreciation or the economy doing better than expected, or oil being pushed up by whatever reasons, which lead the Reserve Bank to revise up its inflation forecast and forecast that we're going to miss the target for the next 2 years and there's no prospect of coming back in, then the response would have to be obviously very different. Otherwise, there's a credibility problem.